Welcome to the CFA Level 1 practice test. Domain, Equity Investments Part 5. How does a fundamentally weighted index typically adjust weights after a security's significant price increase compared to a market cap weighted index? A fundamentally weighted index would increase its weight in the security, similar to the market capitalization weighted index, due to its increased market value. B. Both indexes would maintain their original weights in the security until a scheduled rebalancing or reconstitution event occurs. C. A fundamentally weighted index would tend to decrease its weight in the security, reflecting a contrarian effect, while the market capitalization weighted index would increase its weight. D. None of the above. Answer is C. A fundamentally weighted index would tend to decrease its weight in the security, reflecting a contrarian effect, while the market capitalization weighted index would increase its weight. What fundamental process does an independent and objective equity analyst primarily support? A. Price discovery. B. Capital allocation. C. Risk diversification. D. Not applicable. Answer is A. Price discovery. When is an equity market index provider most likely to perform a reconstitution of the index? A. Constituent security prices change, altering their original target weights. B. The index provider decides to change the index's target weighting methodology. C. A constituent security is acquired by another company and is subsequently delisted. D. All of the above. Answer is C. A constituent security is acquired by another company and is subsequently delisted. What most likely explains an equal-weighted index's outperformance over a market cap-weighted index with the same securities? A. An increase in dividend payouts from the largest constituent securities in the market. B. Outperformance by securities with smaller market capitalizations within the index. C. Frequent adjustments to the divisor of the market capitalization weighted index due to corporate actions. D. None of the above. Answer is B. Outperformance by securities with smaller market capitalizations within the index. Which action by an analyst changing a recommendation from hold to buy likely violates CFA fair dealing standards? A. Discussing report conclusions at a public conference post-release. B. Alerting select large clients about the rating change before general dissemination. C. Ensuring simultaneous report distribution to all the firm's clients. D. Not applicable. Answer is B. Alerting select large clients about the rating change before general dissemination. According to risk-return principles, rational investors demand A. A reduced expected return when assuming higher diversifiable risk. B. An expected return independent of overall equity risk level. C. An increased expected return when assuming higher non-diversifiable risk. D. None of the above. Answer is C. An increased expected return when assuming higher non-diversifiable risk. Which order best protects a $40 long stock from losses below $30? A. IOC stop buy order with stop price $35 and limit price $45. B. GTC stop limit sell order with stop price $35 and limit price $30. C. GTC market on close order with stop price $35. D. None of the above. Answer is B. GTC stop limit sell order with stop price $35 and limit price $30. What information do prices reflect in a semi-strong form efficient market? A. Only past market data. B. All public and private information. C. All publicly available information. D. Not applicable. Answer is C. All publicly available information. How does a rise in market interest rates primarily affect an investor's leveraged equity position? A. Equity percentage immediately declines, increasing margin call risk. B. Borrowing cost rises, reducing the investor's net return on investment. C. Broker increases maintenance margin requirements, requiring more funds. D. None of the above. Answer is B. Borrowing cost rises, reducing the investor's net return on investment. What does a significantly higher P/E ratio than industry average most likely indicate about a company? A. Lower future earnings growth. B. The higher required rate of return. C. Higher future earnings growth. D. Not applicable. Answer is C. Higher future earnings growth. Thank you for watching. For more learning videos and tutorials, please subscribe to BISP Trainings.